Our next guest warns economic weakness could drive stocks back to the October lows. Joe Lavorgna, the former chief economist for the National Economic Council, he's now chief economist at CNBC Nikko Securities America, joins us. Joe, it's good to see you. You've been in the camp. You've been expecting recession. The January data has shown anything but.
We had a GDP recession, an inflationary recession early last year, and my guess is we'll see a more traditional recession, Sarah, this year based on the yield curve, the index of leading indicators, the senior loan officer survey, and the fact the Fed has to get inflation back to 2%. And as you guys laid out quite nicely, the fact that it's not coming down as quickly as it's supposed to means that you'll have to have a recession to get that core rate lower, because you always get core rate lower when you have recessions. It doesn't happen on its own. So the January data look good. It does look like it's a weather effect. I'll give you, for instance, if you look at the production of natural gas and electric output, it fell 10% last month. That's the biggest drop, with data going all the way back to 1939. So to me, this is a temporary reprieve on the data.
Yeah, a lot of people are saying January looks seasonal, but I don't know if the Fed is going to look at it that way, Joe. The Fed has to get ahead of inflation and has been leaning into the strong data.
The Fed, I loved Guy's comments that he's no fan of the Fed. The Fed waited way too long to raise interest rates, way too long. And then Jay Powell wants to be reappointed, and he got his inflation fighting stripes. And now they've gone way too hard the other way. But as you know, Sarah, inflation is a lagging indicator. Monetary policy itself works with lags. They'll get ultimately what they want, which is lower inflation, but it's going to mean a recession, though.
Guy?
Yeah, Joe, what's their put? You know, we had a conversation with Richard Fisher. I think the put is in the form of the credit markets. I don't want to say seizing up, but sort of showing some signs, because it's clearly not the equity market anymore.
You know, the credit market for sure, because the credit market always causes systemic issues, and you're referring basically to the financial market breaking. My guess is it'll be something more banal. It'll be the labor market. The labor market shedding a couple 100,000 jobs a month for a few months in a row, with unemployment now quickly moving up into the mid to high fours. My guess is the Fed reaction function will change. Jay Powell will go from uber hawkish to being a dove very quickly. But of course, if the credit markets break and there are systemic issues at the same time, that would only reinforce easing and the Fed pivot. By the way, I still believe in the Fed pivot, and I still expect the Fed to cut rates this year.
Jeff, did you have something?
Hey, Joe, it's Jeff Mills. Just a quick question relative to interest rates. You know, I know that your view later in the year is for the Fed to probably start cutting because of a recession. Can you just put that into perspective for people? I think we've all been so trained over the past 10 years to think of that first rate cut as being a good thing for the markets, when historically maybe that's not the case.
Yeah, that's right, Jeff. If you have a soft landing, if there have been 6 times where the Fed has cut and there's been a soft landing, and the equity market's up massively in 3, 6, 9, 12-month periods by a lot, like 20, 25%. However, if the Fed's cutting and there's a recession, then those initial rate cuts are typically quite negative for equities. Historically, the timing from the last hike to the first ease is about 3 months. Over the last 5 cycles, it's elongated out to maybe like 11 or 12 months. But this Fed has been so aggressive, Jeff, and that yield curve I keep looking at every day, getting more and more inverted, and banks tightening standards. These are all classic cyclical signs that the Fed has overdone it. And yet, because of the point Sarah made in trying to get that inflation lower, the Fed's now stuck. They can't give you any nuance on the economy. They're going to get this economy lower, and that's going to be bad for equities. It's going to be bad for credit.
Really quickly, Joe, even the market has priced out the cutting notion.
Almost, Sarah, almost. They got one little cut in December.
You think there's going to be a cut because inflation comes down all the way to 2%?
No, I think
because the economy is going to be hurting so badly?
The economy is going to be hurting so badly. For example, you could lose upwards of about 800,000 construction jobs, just construction alone, if you match what the labor market's showing on construction versus the inflation-adjusted construction data.
All right. Putting yourself out there, Joe. Thank you very much. Appreciate it.
Won't be the first time, Sarah.
No, we know. Joe Lavorgna, let's trade this, Mike.
Yeah,
First to you.
You know, I will say, look, one of the things I think that people really fail to grasp in a situation like this, if you look back historically at how much, say, S&P earnings can fall when things go the wrong way. We have rising capital costs. We had consecutive years right after December of 2007 where we had 15-16% year-on-year earnings declines for the entire S&P. And then again the following year. It was not until about 33 months after December of 2007 that we even got back to earnings where they previously had been. You know, this is just not an environment that sets up very well. And, you know, he was talking about construction jobs. We have, what, 9-month supply now, I think, of new home inventory. These types of things are necessarily going to take time to percolate through, just like inflation has taken time to percolate through. And, you know, you end up in these kinds of waves, and I think that's what we're in, and I just don't think it's over yet.
Guy, you know, I'm kind of bummed that Tim Seymour wasn't here, because last time I was on the show, it was like a month or two ago, he was giving me a lot of grief for saying, hey, the dollar could still rally this year. Everybody's on the one-way train, dollar weaker. Guess what? We're at a near 2-month high on the back of all this Fed hawkishness talk.
What have I told you for years, Sarah?
You told me to quit and go trade Forex. Yes.
No, I didn't trade you to tell you to quit. I said if you weren't an extraordinary journalist, you should be trading currencies at J. Aaron, and you would be great at that as well. And you're right. The dollar probably goes higher here. But if Joe Lavorgna is right, and the Fed cuts in the back half of this year, I will tell you something. That won't be a very good environment, because inflation's still going to be a problem. And you know what's going to work? Gold's going to work. And I know you're going to be like, take your tinfoil hat off, Guy, and I will later. But the gold market is poised here. Central banks have been buying it in record amounts. And if you catch a whiff that they're going to pivot, gold's going to go a lot higher.
All right. No tin hat. I think that's a legit view.